Good afternoon, everybody, and welcome to another quick video educational session here from Level Financial Advisors. I'm Mike Heeben, the Chief Operating Officer with Level, and I'm joined today with my esteemed colleague, Michael Angelucci, CFP, MBA. And Mike, today the topic du jour is the Silicon Valley Bank collapse, the subsequent government bailout, and all the news flying around about SVB and now Signature Bank. So maybe a great place to start would be just to, in a nutshell, what happened with SVB and Signature, and maybe you can explain kind of what that means for the viewers.
I mean, this is obviously affecting the market a little bit today, and it's got some people worried, but I want to emphasize that if you have money in a bank that is FDIC insured and you have less than $250,000 in that bank account, you are covered. The government will honor your deposits at the bank. So people with deposits in banks are safe. Why this is a unique situation is really because SVB was the bank, has been the bank really for 40 years for high-tech companies in Silicon Valley Bank. So what has happened over the last few years is we know the tech industry grew tremendously. And what was happening when that occurred is there were a lot of investors, venture capital money. So a company like Roku or another tech company may have raised tens of millions of dollars, in some cases hundreds of millions of dollars, that they had to place someplace when they got this money from investors. The place to go was SVB. So Roku, I mentioned Roku because I just read this morning, they have about $500 million at SVB. So they had to put their bank deposits, their operating account someplace, they put them at SVB. What's happened is we know the past couple of years, inflation has taken hold. The tech industry has been hurt especially bad. They've been doing layoffs. That resulted in less people investing in tech. So they're getting less cash flow from outside investors. And now they're starting to draw on the deposits at SVB. They need to make payroll. They need to pay other bills. They're pulling their money out of SVB. At the same time, interest rates are going up. And the money that a lot of people had at SVB that was maybe earning 0.5%, they could now pull that money out and invest in US government securities at 4 or 5%. So not only are they pulling the money out because they need it for their own operations, they're also pulling it out to put it someplace else where they could get a safe return higher than SVB was giving them. Now, SVB was running into trouble because they're essentially doing the right thing that a bank should do. They're taking in the deposits, they lend money out for mortgages, for business loans, and then a lot of the money that they had, about 128 billion of their 200 billion that they were worth, was invested in US government securities. Very safe, considered the safest securities in the world. They were being prudent. The one thing they weren't as prudent about is they were buying longer term US government securities. And when interest rates started going up, those treasury bonds started going down in value. In fact, they've lost about 17 billion in value. SVB has lost 17 billion in value. So at the same time people are pulling money out, they need to create money. They need to create cash to pay those depositors pulling money out. So they had to sell their US treasuries at a loss. If they would have held those treasuries to maturity, they would have got all the money back, but they had to sell them at a loss. And then some of the investors and some of the depositors at SVB saw that this was happening and basically created a bank run. 42 billion were requested in withdrawals on Friday alone. So this is a classic bank run. And really the issue is very unique because this particular bank and a couple of the others that are in the news are very concentrated banks. They're not diversified. SVB is all invested in tech. And so we're in an environment where tech is getting hit. People are pulling money out. They can't create the cash quick enough to pay the depositors withdrawing money, and the federal government had to step in. And I'll add, The difference between SVB and some of our local banks here is our local banks are well diversified. They're not all dependent on one industry. So let's say XYZ company, manufacturer in Cheektowaga has their deposits at their operating account at M&T Bank, and they run into trouble. Well, M&T Bank has thousands of depositors that aren't in trouble. As I said, the difference is SVB had all their depositors all from one industry that started to run into trouble and created this particular bank run on SVB.
So, Mike, we're getting questions from our clients. They want to know what type of impact this is going to have on their portfolio. The first question I've been seeing come in from clients is, should I pull my money out of Schwab Bank? So what are we telling our clients when it comes to the Schwab Bank versus their investments with us?
There's two different things. Schwab Bank would hold savings deposits for some people at Schwab Bank. And again, like any other bank, FDIC insured, those deposits are safe. Nobody thinks that Schwab Bank is in trouble at this point. As far as any of your investments at Charles Schwab, whether they be individual stocks, mutual funds, ETFs, individual bonds, they are held in custody at Schwab in a separate trustee. They're segregated from Schwab Bank. They're segregated from Schwab Corporate. And this is important, whether it's Schwab or whether it's Fidelity or Vanguard or any other of the big brokerage houses, custodians that hold your money. They are required under regulation, SEC regulation, to keep those monies segregated. They cannot touch your money. Those are your investments in your name that Schwab manages for you through a separate trustee that they cannot get at if they run into trouble.
So if a client has, let's say, a cash management account with $400,000 in it, is there anything they should do differently with that account? Knowing what you know today?
Our cash management account are the accounts we have that are managing bond funds for people.
Correct.
No, those bond funds, those are accounts where we've bought individual bonds or FDIC insured CDs for people. Exactly, they fall into the exact category I just mentioned. They are held separately away from Schwab. They're in the client's name. The only way they could lose money on those is if the federal government defaulted on their obligations, right, which is not going to happen. In fact, today, those investments are going up in value because there is a flight to safety right now. U.S. Treasury, especially short-term U.S. Treasuries, are going up in value because people are buying them, driving up the price today.
Okay. And so for our clients' portfolios at large, the questions might be, okay, considering this failure, considering maybe there could be future failures, what are we saying about our portfolios? What's the risk to our portfolios now, given this situation? What's your first take on this, knowing what you know today?
I'm not worried. We're going to see some volatility, especially where we're seeing it today in the small value market with a lot of small regional banks being hit. Last I looked, the overall market was still positive today. So we're not recommending any changes at this point. It's always buy and hold. There's always going to be some sort of issue in any one of the asset classes we have that cause temporary difficulties and downturns. That's why we diversify. That's why we hold many different asset classes for our clients. And there's no fear that there's any sort of contagion that will rip through the economy at this point, hurting all investment classes. In fact, there's even discussion now because of this issue, the Fed may start to hold off on raising rates or maybe even lower rates in the future. So that's affecting some stocks positively, thinking that the Fed's going to start to hold off on raising interest rates. So there's a lot of complex factors going on here, but nothing that says that the economy is failing and that the long-term projection for stocks is anything but positive in the long term.
Okay, great. Anything else you want to add to the discussion here? Anything we haven't touched on? We just wanted to get something quick out to everybody to let them know that, we are monitoring it and educating ourselves on this whole situation, just like everyone else. Anything else you want to add, Mike?
No, nothing other than your bank deposits are safe. The FDIC has come out and said that. And in addition, the Federal Reserve has actually made some provisions for banks to help them with this issue around the declining value of their safe investments. So the Federal Reserve has said they've put in place a special provision where they will give banks the cash for the actual full value of those securities for up to a year in case they run into issues where they need liquidity to pay depositors. So the government has stepped in with some measures. There's still going to be some scary things you're going to see on the news, but can't emphasize this enough. This is why the FDIC was put in place during the Great Depression, was to help people feel calm about their money that they have in their bank.
Okay, well, great. So we're certainly going to monitor this situation regularly here at Level Financial Advisors until our next update. This is Mike Hebron, Level, and Mike Angelucci, one of our financial advisors. Everybody have a great day.